Investing is probably one of the most important things that you need to know a lot about in order to achieve financial independence. But it can seem very daunting, it can seem very complicated, but it doesn't really need to be if you're just on the path to financial independence. Investing doesn't really need to be that hard. A lot of us just make it a lot more difficult than it really needs to be. And that's why if you're watching this video, make sure you stay to the very end because I have an action plan for you to get yourself to financial independence by investing very, very smartly. But first, let's start out with 8 really great best practices when it comes to investing that you need to know about. And the very first one is to keep your investment fees low. Okay, this is very important for achieving financial independence and for investing in general. You want to keep your fees low. This is a really good rule to follow when it comes to investing. That's because the effects of fees on your portfolio performance can be very drastic, even though they seem very low. So for example, if you have a 1% fee, like a 1% annual fee on your investment portfolio, let's say you have it invested with an advisor and they charge you 1% in order to basically invest your assets on your behalf. Well, that doesn't seem like very much actually. 1%, it doesn't seem like very much. But over the long run, that is a very expensive fee. If you invest $1,000 per month for 40 years, 1% of that is going to be $800,000 lost of wealth that's going to go to fees if you paid 1% on that investment. So that 1% doesn't seem so small anymore. By contrast, if you're investing in a typical index fund, one maybe that's tracking the total US stock market, the annual fee for that might be 0.05% or something similar to that. So over that same period of 40 years, that's only going to be $45,000 of fees versus the $800,000 of fees if it was 1%. So as you can see, fees are really important. But the next thing is really important as well. And number 2 on this list is to know the risk and return curve. Okay, this is a very important fundamental. So basically the risk versus return curve is often talked about in relation to stocks and bonds. And so this is basically how much risk you're going to take and how much return you should expect out of that. So the less risk that you're going to take, generally the less return you're going to have. Whereas the more risk that you're willing to take, generally the more return that you're going to have, as long as it is actually calculated risk and not unnecessary risk. So this could be summed up with the word volatility. Volatility is often referenced as being what risk is, but volatility is basically how often and how drastic your investments can change in their value. So this is a really good way of looking at volatility when it comes to stocks and bonds. You actually need to apply what your individual risk tolerance is how much risk can you actually take? Are you able to take a really high amount of risk and therefore go after a really high return? Are you only able to take on a little bit of risk because you can't really stomach drastic fluctuations in your portfolio value? So that's something that's going to be very individual to you, and it's something that you really need to know about. So take a look at the risk and return curve and try to figure out what is going to be a good asset allocation for you. And that might take time because you might actually have to live through a little bit of fluctuations in the stock market before you can kind of figure out how much you can actually tolerate. And then a really good, fundamental to know when it comes to investing for financial independence is to try to always keep a long-term mindset. Try not to think short-term, because so many investors today, or so many people getting involved in investing today, I should say, they have such a short-term mindset. Basically they have the day trading mindset where they're just trying to make a quick buck. And maybe that does work for them. I'd have to argue that it only works for a very, very small sliver of people. But the long-term mindset can work for a lot more of us. So if you look at the general overall stock market, you can see that it is very volatile in a short amount of time. So if you look at each year to year, there could be drastic increases in value and drastic losses in value, and that could be very scary. So people that are short-term mindset are looking at that and just trying to time it and trying to get those short-term returns. But someone with a long-term mindset, they take a look, they zoom out on the stock market and they look at, wow, the stock market is going up, and it has been going up for a very, very long time. The more you zoom out, the more you can see the drastic change in the increase in the stock market in the United States at least. And so that is something that you should probably develop when you're becoming financially independent, when you're trying to become financially independent and you're investing in stocks and bonds and such things like that in the market. And that is most likely, no, that's not guaranteed, going to lead you to some pretty good returns and allow you to build a lot of wealth over time. So historically, the S&P 500 itself has actually returned about 8 to 10% over long periods of time, depending on what periods of time you're actually looking at. But when it comes to those 8 to 10% returns, it has not been a smooth ride. There has definitely been years when it's been negative 30%, years when it's been plus 20%, years that it's been plus 10%, years that it's been minus 10%. So it has not been a smooth ride. But if you look at the long-term trajectory of the stock market, it has been about an average of 8 to 10%. And that is something that if you are trying to achieve financial independence by investing in the US stock market and other stock markets around the world, that is something that you might want to develop when it comes to your investment mindset. Historically, 8 to 10%, that might actually be good for me. If I can expect 8% over the next 40 years of my investment career, that could be a really good thing. That will lead to a lot of wealth, depending on how much money you're actually investing into the stock market. And really, what this really has to come down to is, yes, you do have to speculate. In this case, you're speculating over hundreds of companies, possibly thousands of companies, whereas most people today are coming at it from a very short-term mindset and looking at extreme speculation, which I would tie a little bit more into gambling rather than into investing. And that leads me very well into concept number 4. So maybe you should only be investing in something that you actually understand. If something is way too complicated for you to understand, if an investment option is too complicated for you to understand, maybe you should not be investing in it. Try investing in only stuff that you actually understand. For example, investing in a stock is very easy to understand. Stock is, ownership of a company. That is very easy to understand. And so that is something that I would invest in because it's really easy to understand. And it's the same thing with, a mutual fund or an exchange traded fund. This owns stocks and I'm investing in that fund that owns those stocks. So it's something very easy to understand, and that's probably something you should be investing in. If it's something that's very, very complicated, try asking yourself, is someone trying to actually sell me this investment? Is this a product that I'm actually being sold, rather than is this something that I want to invest in? There are many investment products out there that have been created just to sell as a product, to be marketed as a product to sell to you, because those being sold, selling those products, selling those investment products, make the people who are selling them a lot of money, and it might not be the best choice for you. It might not make you a lot of money like you would hope. And so that's why it's really important to just invest in something that you only understand. And of course, that comes with increasing your knowledge and understanding more. But when you're first starting out, there's nothing wrong with investing in only things that you only simply understand, things that are actually simple. And that's why this is something that I really like to follow when it comes to pretty much most things in life. It's known as the KISS. Keep it simple, silly. Okay, so it's not really silly, it's stupid. Keep it simple, stupid. That's something that I really like to follow in my investment philosophy. If it's not simple, if it's not something that's easy to understand, then I probably shouldn't be investing in it. That's something that I have definitely taken, and maybe it could be something that you apply to your investment philosophy. And number 5, a major concept that you definitely need to know is to maintain your tax efficiency. So there are different kinds of investments, obviously. There's so many different kinds, but also there are so many different kinds of tax consequences that can arise from those investments. Let's say, for example, if you're investing in a stock, you buy the stock, maybe 3 years later you sell the stock and it was $20 more than when you bought it for. Well, that's going to be a long-term capital gain if it was in a taxable investment account. If it was in, like a tax advantage retirement account or something like that, then you're not going to realize the gain when you sell it within that account, only when you withdraw it. So it's really important when you're developing your investment plan that you try to maintain tax efficiency. For example, if you have REITs, real estate investment trusts that pay off lots of dividends, then you're probably not going to want to invest in those within a taxable brokerage account, because those are going to be constantly paying dividends. So unless you're actually relying on those dividends as income, you're going to owe taxes on all those dividends you get. If the real estate investment trust was in a tax advantage account, such as an IRA, then all those dividends that get paid within the account, you're not going to pay taxes on those dividends because they're within the account. You're not going to pay any taxes on money from that account until you actually withdraw from it. And so there are many different examples that you can have on that, but a really important concept is to definitely look at maintaining tax efficiency, because if you're not paying attention to that tax efficiency, you could end up paying a lot more in taxes, and that could definitely take away from your investment gains. Going back to that stock example, if you sold it only 6 months later and you still made $20 in gain, that's cool, you made that gain, but it's going to be taxed at the short-term capital gains rate, which is going to be your ordinary income tax rate. Whereas in the example I mentioned before, the long-term capital gain rate is going to be a lot more favorable. The long-term capital gains are a lot more advantageous than they are for short-term capital gains, and that's really important if you're investing in a regular taxable investment account. And next up, number 6 on this list, it's a really important concept to know, and that is to diversify your investments in order to spread your risk out. Okay, so if you're investing only in a handful of companies, for example, it could be very risky because all of your money is relying on those companies to succeed, and those companies could fail at any time. But if you are diversifying, let's say you're investing in 500 companies versus if you're investing in 5, you have a lot more of your risk spread out. So your risk is spread among 500 companies rather than 5 for this simplified example. And that's why diversification of your investments is very important. So not only in the amount of companies that's important, but it's also pretty important when it comes to your allocation. So for diversification, it might be important for your investment portfolio. It might be important to invest in stocks. It might be important to invest in bonds. It might be important to have some money in cash. It might be important to have some money in real estate. It really just depends on your investment goals and your investment philosophy. But those are different ways that you can actually diversify. And in addition to that, when it does come to diversification, it's also important to include that you can diversify too much. There is such a thing as over diversification. And what this means is basically if you're invested in every single thing there possibly is, then some of those are going to be winners, some of those are going to be losers, and that could actually bring your investment gains, closer to zero, because those losers are going to offset those winners, and those winners are going to offset those losers. And so if you're literally invested in every single thing, not all investments are created equal. And so if you're invested in every single thing, that could potentially, lead to lower returns because some things are failing while some things are succeeding. And so be careful not to over diversify as well. You don't actually need to be invested in every single thing, every single asset, every single company. That is not true. But you do have to have some diversification if you want to limit the amount of risk that you are taking. But if you over diversify and you're investing in every single thing trying to eliminate risk, you're going to definitely, probably, most likely see smaller returns. Number 7, a huge fundamental concept of investing on your way to financial independence is to utilize the right investment accounts. Now, I kind of touched on this a little bit earlier, but not too much, because there are so many different accounts that you can invest in, and there are different times and different situations where you might want to take advantage of one or the other. So, for example, we have the Roth IRA or a Roth 401k or something similar to that. So a Roth can be great if you want to withdraw money in the future tax-free, because a Roth basically in the future, when you withdraw money from a Roth, you don't have to pay taxes on that. A traditional IRA or a traditional 401k or something similar to that could be great because it can get you a tax deduction today. So as it stands today, if you contribute money to that and you're able to take a deduction for it, then you can reduce your taxes today, and that could be something really great for you depending on what your situation is. Another one could be a regular taxable investment account. So sometimes you just want to have that money easily accessible, and this might not be the most tax advantage because it's just a regular brokerage account. It might be important for you to have assets within a taxable investment account. Another reason why you might want to use a regular individual taxable account is maybe your income actually isn't earned income from a job. Maybe it's all investment income, or maybe it's all passive income or something like that, and you're technically not allowed to contribute passive income or unearned income to retirement accounts. And so maybe you're forced to invest in a taxable investment account. Maybe you have access to an HSA, which is a health savings account, because you have a high deductible health insurance plan, and you could invest within that account as well. So there are many different accounts that you can utilize, and I can't possibly discuss every single one of them, but there are definitely circumstances and situations where one account is much more preferable over the other depending on your individual circumstance. And so try to educate yourself as much as possible and learn when to use the right investment account for you. And number 8, when it comes to investing your way to financial independence, a really important concept is to choose the right investment products. It's really important that you choose the right things to invest in, or better things to invest in for your situation. So for some people, it might be investing in stocks. For some people, it might be investing in bonds, or both. For some people, it might be investing in mutual funds, exchange traded funds. It might be real estate. So there's obviously so many different things that you could actually invest in, just like there are so many different kinds of accounts you can invest in. But there are definitely some that are better than others. For example, when it comes to my philosophy, I think that index funds, which are mutual funds or ETFs, are one of the best investments for most of us who want a hands-off approach to investing. And it's definitely going to depend on your goals. You could probably make a lot more money investing in real estate, but it's going to definitely take a lot more of your time. It's going to take a lot more effort and a lot more research to make sure you get things right, and that could be an avenue that you want to take. But for the sake of this video, let's go ahead and put together a plan for you right now, a plan for you to get started investing for financial independence. Or even if you already have some experience investing, this new plan right here might actually work better for you over the long term in order to get you to financial independence. But before we move on to that, please, if you're liking this video so far, make sure you like it and you give it a thumbs up. It really does help me out, and I really do appreciate that. And it really does spread the message to other people who need to hear this message. So please make sure you hit that like button. I would really appreciate that. Now let's put it all together. Let's put all of these concepts together and create a plan for you. Now, your plan, an actual optimized plan, could be a lot different than this. But for the sake of this video, I think a really great plan for most of us, which is what the plan that I actually I do myself, is investing in index funds. So as I mentioned earlier, index funds, they are mutual funds or exchange traded funds, and they track a certain market index. For example, the one that I like to do in order to keep my portfolio simple is to do a 3-fund portfolio, which an index that invests in the total US stock market, an index that invests in a total international stock market, and one that invests in a total US bond market. Okay, currently though, I do not have any bonds, and so right now my portfolio is a 2-fund portfolio, but when I do want to add more bonds, I will add a total US bond portfolio to have a 3-fund portfolio. So those are the investments for this plan. This is the reason why I would choose this plan, because these investments, they fit into every concept that we mentioned previously. So for one, they have very low fees. For example, an index fund for the US total stock market, its fees could be 0.05% per year. It's very common to see fees that are extremely low on a total US stock market index fund. Number two, it is easy to adjust your volatility. You could just invest more in bonds into the bond fund and less into the stock fund, like less into the total US stock fund or less into the international stock fund. And the more that you increase your bonds and the less that you have in those equities, in those stocks, the less volatility your portfolio is generally going to have. And so if it's really well into concept number two. And then concept number three, it works really well long term. So I've mentioned to you that the S&P 500 over its lifetime has had about 8 to 10%, depending on what kind of period you're looking for. But if you're looking at really long periods, such as 40 years plus, it's going to be about 8 to 10% of a return. And that's why if the future is going to be anything like it has been in the past, we could probably reasonably expect to have similar gains in the future as well, hopefully. And so that's why it works really well long term. It's something that you can set and forget it. You can just keep investing into these indexes, and then over the long term, you should reasonably expect to have a yield around there, an investment return on that. And next, on concept number four, it's extremely easy to understand. It's easy to understand what an index fund is. So you can just go and look it up on the internet, read a little bit about it. And actually it's generally pretty easy to understand what it is. So it's not complicated. And that's one of those really important concepts. Next, at number 5, tax efficiency. These are very, very tax efficient investment vehicles, and that's because index funds, they do pay out some dividends, but generally those dividends are going to be qualified dividends, and so there's not going to be very much tax on those dividends, and that's only if you're invested in a taxable investment account. And generally they're not going to have very high turnover, and so they're not going to have really high capital gains that are going to get passed on to you, and their turnover rates might be very low because the index doesn't really change that much, and so you're going to have a low amount of tax burden if you are invested in a taxable investment account. Now, if you're invested in a retirement account or something like that, then you don't really have to worry about that because none of those realized gains or anything like that are going to be taxed while the money is within that account. And then with concept number 6, it's very easy to diversify your investments by utilizing index funds. And that's because one index fund, for example, that tracks the total US stock market, that index fund, that is about 3,500 companies, give or take, depending on which index you are tracking. So, that's thousands of companies right there. A total international index fund, that could be another, 2,000, 3,000 companies, whatever it may be. And so it's really easy to diversify with index funds because a total US stock market index fund, for example, it can be invested in, 3,500 companies or something around there. A total international fund, that could be invested in, 2,000 plus companies. And so if you add those together, you have 5,500 different companies, give or take, that you were actually invested in. And you're automatically pretty much diversified, and it's super easy. You don't have to really do very much. You have two funds, but those two funds are diversified so well, and so it works really well with the concept of diversifying. And then we had concept number 7, which is to utilize tax advantaged accounts. And it's extremely easy to buy index funds within your tax advantaged accounts. Most employer sponsored retirement plans, such as 401ks, most of them do offer index funds, or at least something that resembles an index fund. And then if you have a individual retirement account that you open up at a brokerage, you can choose any investment that you want, and so you can choose to invest in index funds. If you have a regular taxable investment account, you can choose to invest in index funds. Same thing with the HSA and many other accounts as well. And you can pretty much always find index funds, and so you can use pretty much all of these different kinds of investment accounts in order to invest in them, and so that makes them a pretty great deal. And then you had number 8, which is to invest in the right investment vehicle, and that is what this is all about. And I think that index funds are a really great investment that will get most of us to financial independence. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.